All right, well, on a very significant day for the markets, also a significant day at the Settle household as we sent off our second oldest son just a couple months after we got our oldest home from 2 years off in Nebraska without being able to see him, talking to him, but not being able to see him in person. We just took our second oldest now, who just barely graduated here a couple months ago. We took him to the airport to go off to Ghana, Africa for a couple of years. That we won't be able to see him. We'll talk to him, but we won't be able to see him. So big day in the Settle household, big day in the markets. I'm going to break down this move and break down all its significance. Take a look at a lot of charts. We're going to have this is a big one today, so buckle up. I have to change the speed on YouTube up to the 1.5 or 2 times to get through it all. But we got a lot to look at, and our trade idea is a stock that's got some good runway to go to the upside as well. We'll talk about how to trade that. So let's go ahead and get started. Today is Wednesday, July the 27th, 2022. This is the market outlook from MarketScholars.com. My name is David Settle. Hey, before we get started, I invite you to subscribe to our YouTube channel, click that thumbs up icon, like our video, comment on the video, join our website on MarketScholars.com. There's that link popping out up there. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog here, check out these things over on the right. Come down here, click on that heart. It opens up this tab. Hit that like button. Same thing here. Click on the thumbs up icon. Opens up our this Facebook tab. Hit that like button. Again, the more you do that, it helps get our content out to more of our followers on those social media platforms. All right, let's start off taking a look at the S&P with the market forecast indicator like we always do. And you can see, that's a pretty decent move, obviously, to the upside here. You've got a 4.5% move up above 30-day moving average. We haven't seen that for a while. Last time we saw that was back here in March. If you recall, the FOMC meeting was right here, March 16th, I believe, right before options expiration. We had a really good rally that day of the Fed meeting, and then that rally continued through options expiration on into the end of the quarter, right, into the year with a overbought cluster. So that's what that meeting led into. We were a little bit more bullish already going into this meeting, but this particular meeting, you can see getting to dark green shading and a green line for the second day in a row. So it's been a while since we've had that pattern. The momentum line rising up into the overbought levels. The near-term line also getting out of bearish territory. Has not quite gotten into bullish territory, but barring a collapse tomorrow, more than likely that's going to happen. More than likely we're going to get that near-term line to come up into the green, and that would make this obviously a significantly bullish near-term low point, and it would also make that, we're already at a higher high compared to like this one here, where we ultimately got here, let me get rid of those tags for a second. So we're already at higher highs. The near-term line more than likely will not get up above to a higher high. And there's a good, there's obviously nothing's nothing's guaranteed, right? And you can see the last 3 near-term peaks all did get above 90, so they all did get to really, really strong levels. If this one does not, then you're setting up for a divergence here, but still. That's a good move. We're in the top 10th percentile in terms of this past year. You can see there's only been a few times. If you follow my cursor all the way over to the left, well, here let's just throw on the horizontal line here. So we're at 4.55 today. So there's only been a couple other times this past year that we've been more than 4.5% above. Over here, they kind of ended that rally in November. We didn't go down necessarily, but we didn't go up anymore either. We kind of just flattened out. And then over here, you can see when we did get more than 4.5% above, we kind of got that little bit of a fake out breakout there. And obviously, you can see what happened again well after. I did mention today, if you follow me on Twitter, you'll see this post that I put out there. Here we go. Down in here, not that one, it'd be this one. So this tweet came out about the NASDAQ 100 on Fed days and the big moves that we've had on Fed days, that total on the Nasdaq 100, those 4 days total a total gain of 1,740 points on the Nasdaq 100. Despite those gains, right? On March 14th, 2 days before we had that rally, the March 15th was a little bit higher, but March 14th was the low point on the NASDAQ. We're actually below that low point right now, despite the fact that we've had these 4 days after that low point, and despite the fact that off of what was a 13,000 level, you can see off of a basis of 13,000, if we only had those 4 days of 1740.69 off a basis of 13,046.64, those 4 days by themselves would have been a 13.33% rally. Those 4 days by themselves would have been a 13.34% rally off of that level. But we're not 13.3% higher. We're actually 3.5% lower than that level. So that means on all the other days, despite those 4 days, we've actually lost 2,100 points combined on all the other days. So a net loss of 445. So that kind of gives you an idea of how bullish the markets have been on the past 4 Fed days, including, as you can see, that March level, which kind of ended that first leg of the first leg lower on this market sentiment run. And then now this would be the second leg lower that appears, that has ended. The intermediate line is in bullish territory. This second leg has ended. It is a lower intermediate low. There's a prior intermediate high point. We're at the 38% retracement level of the prior intermediate high point. So that's the idea. Like, okay, last time, if you notice here, when we retraced up the first leg, that first down leg right here, we got above the 62% retracement of the first leg lower, and almost made it up to the 78. You notice we got right back down. We got right back down below it, just almost immediately after. So that was the first leg lower. Obviously, this is the second leg lower, and we're nowhere near the 62%. Like I said, we're at this 40-20 area, which is the 38% retracement. And a little bit higher up to about 40-90 is where the 38% retracement of this entire decline is, where we're at right now. So needless to say, we're starting a new intermediate run. The last one didn't last very long. We're coming off of a lower intermediate low point, and we're still nowhere near a higher intermediate high. In fact, we're kind of at normal retracement levels for both the prior intermediate decline as well as the combined last 2 intermediate declines combined into this one market sentiment decline. Market sentiment's rising. It's still in bearish territory, but it's rising because this intermediate line's rising. And again, we're 4.5%. To kind of give you an idea of what this looks like, we're 4.5% now, but coming off our last declines, we got well above 4.5% above the 30-day moving average coming off the COVID, and we are much more, we are a lot more bearish. And then you can see here, we also got more than 10% below the 30-day moving average. We did also get up to 4.5% here, kind of paused, and then broke out with a little bit higher, but never did get above this level. You can see this is kind of, where we're at right now, as you can kind of follow along across, and we didn't quite get below 10%, below the 30-day moving average like we did at the end of that level. But follow that blue line along to the left, and this is about a limit as to how high we get above the 30-day moving average. That doesn't mean that we can't keep going up. It just means that the moving average will start to move up at about the same pace. So we might not have the same momentum going forward from here, despite the really, really good move that we've had today. That's the S&P. The NASDAQ 100, if you look at that one here, you can see we are 6% up above the 30-day moving average. Again, dark green shading in the green line. We are also at that 38% retracement level and resistance level right now for this retracement. We are above that 23% retracement level. Last time we got above it, we didn't stay above it. So we'll keep our eyes on that one for the Russell 2000. Easily still below these two important lines, the red and the black lines, which are these retracement levels that we have broken below back in May, that we need to get back up above if we're going to kind of end this thing on the NASDAQ. Same thing on the Russell 2000. So those two lines are a little bit more split apart. The red line is lined up with that 38% retracement, also that 62. I mean, this 1950 area is going to be a very significant resistance for the Russell if we ultimately end up getting there. We are breaking above this combined 23-38% level today. We did this before last week, and it didn't hold. We're higher above the 30-day moving average today, almost 6% in the 95th percentile. That's a really, really high level for this, and we'll see if how much we continue to extend with the same momentum that we've seen. The weekly chart is looking better. It's still not, it was kind of weak earlier, but today's move has really helped it out. Still not closing above that high, but at least it's pretty bullish, and it's going to finish pretty bullish. And as of right now, you'll have a pretty bullish candle next week too. And you have the green arrow, right? We were flirting with the red arrow again earlier in the week, and now that's, we're well established into a green arrow there. From a 3 green arrow standpoint, you can see the MACD's turned up all across the board. So green bars in the histogram all across the board. We're still at resistance there in the Qs. We're still at resistance on the spiders. We're kind of well below resistance on the diamonds. And then you can see we're trying to break through the resistance on the Russell. All with 3 green arrows and a rising histogram. And you can see now a green line, a rising moving average. Again, we just haven't had this green shading and a rising moving average this entire time. We didn't have it over here. We didn't have it over here. We did briefly there, and only lasted a couple of days before we peaked, but we didn't have it over here. All right. So there's that. Let's take a look at some of these other oscillators here. Let's see if we get some breakouts. I've kind of shaded these areas in my class today. So this is the bullish area for the RSI when the bottom end of that range is 40 of bullish range. The top end is 70, and you can see it briefly. You'll get above 70, briefly you get below 40, but for the most part you stay in that range when you're bullish. When you're bearish, you flip it around, right? You come down into below 40 and you kind of stay there. So that's kind of what happened. We actually got below 30 here, and that kind of helps kind of solidify the beginning of the move when you drop all the way down below 40 and get below 30. So now it's hard to get back up above 60, and you can see it's very brief that we've been above 60. That's the top of the bearish territory, and 30 being the bottom. So we'll see the RSI or the CCI drop below 100, pop back up above 100. Obviously, we'd have to take a significant move to get that up there, and we have to get above 60. Probably have to get above 70 to really signal the break. Again, like this, out of bearish territory, like getting above 60 and getting above 70 to really solidify the new trend. You can see it did that coming off of COVID, and it quasi did that over here. Got to 70.18 after breaking above 70 coming off of the 2018 low point. So that's, we'd like to get above 70 and really solidify that break by moving all the way up closer to 70, or get above 60, but moving all the way up to 70 to really solidify the breakout. And even this last little peak on the RSI and a lot of these oscillators, we're still not above those highs. In fact, you look at the MACD, and that's the last significant stochastics and MACD peak. This one, it is a lower low point, and so far is a lower high point. In fact, if you were just to Fibonacci lines from that level down to the June peak, so it's in black, you can see you are above the 62% retracement. Trying to make another break up above, you have to get above the 78 to really feel confident about the possibility of a higher high point coming here. So we are above 62. That's a good sign. We really have to hold this move today. Really need to hold this move today. The last couple of times that we've had some big rallies on the FOMC, you can see June 15th is right here. So, you know, we had a pretty decent move June 15th on that FOMC day, and then we didn't hold it. We bottomed a couple days later, and the MACD was actually pretty negative when that happened, but we couldn't hold it. May 4th over here, we had a really good move. The MACD again was negative on the day. We did get above this. We were below the 17. We got above it, and then really didn't hold it the next day. It filled in what gap we may have even had, came all the way back down, and went to lower lows by the time it was done. So, needless to say that, like, we're not quite done just because we had a good up day. The last couple of FOMC meetings was not necessary. Remember, the one before was the 16th, and it did hold the rally all the way up to this kind of quasi fake out move up here before reversing back to the downside. Let's take a look at the RSI and we already looked at this one. The DMI, sorry, is what I wanted to look at. Breaking above 30, below 20. That's our breakout pattern, and we just about have it. This is a very, very good pattern because we want to see light green shading and dark green shading, right? We want to see, you know, when you're bullish, you see light green shading and dark green shading on this pattern here. That means that the ADX is getting up above 25 down here, light green shading and dark green shading. That means the ADX is getting above 25 with a bullish trend. Right, we're getting going here. We haven't had that for a while, but we had a few little instances here coming off of these lows. You kind of got going off of that low point. You kind of got going here off of this low point, and you kind of ended there, and you got going off of this low point with light green shading and dark green shading. You know, you got the ADX rising. It got up, again, above 20 gets you the light green shading. Above 25 gets you the dark green shading. You can see the bullish trends. So we want to see that here. We want to see, get that ADX up requires that we get above 30 and below 20, and we are right there. We're not quite above those levels. We did get slightly above those levels over here. Like I said, kind of a fake out pattern because it looked like we had it. We were at above 31. We were below 19. It looked like we were going to get there, and the ADX had started to turn higher. You can see on that. But then it failed, right? And then we failed and we moved back down. The negative got back above 20, eventually got back above 25. The positive got back below 25, and then that was all said and done. So that's what we were watching for going into the next couple of days here. The Ichimoku cloud, we're still in the cloud. We're not above the cloud, but if we hold this position, we're going to be above the cloud by the time we get out of this pink shaded area. Incidentally, to see how bearish we were here on this washout cycle, we're still not in the bullish trend. I mean, we're almost above 1 on the trend quality. We have to be above 1 to get a weak trend started. We have to be above 50 to get a weak trend started. We're almost there. We're not quite on either one of them. If you look at the Qs, we are there. In fact, the Qs were almost to a, you have to get above the 2.5 level, and you have to get above 65 to signify a intermediate trend strength going, and we're almost there on the Qs, but not quite either. And again, well inside the cloud there, you can see IWM, same thing. We're close to a new trend starting, but we're not there, right? We're just, excuse me, I have to get above 2 and above 65, and we're just not there. Like the Russell just can't get any kind of bullishness going this entire year. It's once we went bearish, we had that brief period at the end in November, but once we hit post Thanksgiving post Thanksgiving move here, it's been a bearish trend one after another with just noise in between, and that's where we're at right now. We're at the top of that bearish cloud right now. So very important time right now for the markets to really solidify this break and get us moving to the upside. One of our bigger up moves that we've had now. The week before we had a pretty decent sized move like this, and you can see, like, we're relatively bullish, but this isn't the biggest move that we've had, and you can see some of these other 3%. We've had 3% rallies. In fact, if you look at the Qs, which we did get over a 4% rally That's the biggest move of the past 52 weeks. But it's not the first 3% rally. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 since the beginning, since that Thanksgiving drop that kind of started this big bout of volatility. 14 days of 3% moves or higher to the upside. And you can see like this one followed up with some bearishness there. This one followed up with some bearishness very quickly. And you can see how every other 3% rally or more was followed up with some pretty significant bearish moves almost immediately. All right, so really important to see that we hold. I mean, this isn't even the biggest gap to the upside that we've had. You can see over here, we've had some bigger gaps to the upside that led to some of these rallies that we had, similar to what we saw here. All right. A couple of other charts to look at. If you look at the volatility chart, incidentally enough, it fell, not surprising. It did not fall to new lows, however, which is kind of crazy because the market did get to new highs. Volatility did new highs compared to last week, but it did not get to new lows in volatility, and especially did not get to new lows over here. It's actually still pretty high over here on the relative index. When you look at the VVIX, it did drop to new lows again. So you have new 52-week lows on the volatility of the index, which again you can see is really, really like, this is, for some perspective, when you get below 82, that's pretty low over the past so many years. That's a relatively low point. The only time it was lower and stayed lower, so if I were to go here, let's just put 80 on here so you can kind of see where 80 is. See, there's that level from earlier, and then we'll keep that one at 100. So there's 80, and you can see the 80 tends to be a pretty low point for the volatility of the VIX. We were below that in 13 and early part of 14, but remember that was fueled by QE3 that we just don't have right now. And of course, we had QE4 over here, and that couldn't even get you below 100. So we are below 100. We're well below 100. We've made a big move to the downside, but we've that quickly have made a big move all the way back down. And you can see other times that we've gotten down to these levels, like when we dropped from above 100 down to 80 like this, you can see how we dropped all the way below into 85s. And so we haven't done that yet, but that would be kind of the confirmation of this bullish trend being established from a volatility standpoint. Looking at today's volume and range, obviously it was a pretty good day for volume. Oops, sorry, wrong chart. Here we go. You can see the volume was at 82 million, so just a little bit above the average. The range was at 8.83 points, but you have to add in the gap. So 390.89, the low 394, so just over 3 points. So you're looking at almost 12 points in gap there compared to 7.5 point ATR. So 82 million shares is right here. That's not, that's a little bit above the average, but the 12 points is way up here. So a really big, significant move. That's kind of like what you like to see to kind of break out. Whether we end up calling this a runaway gap or not remains to be seen, because you can see we did jump up, very similar to what we saw on the 19th. We jumped up, we ran away from the open, did not fill in any of the gap, and then finished with a significant gap and finished with a really strong move to the upside. That one's held so far. We'll see if this one holds. We are above last week's high point, just barely. We're a little bit down in the after hours, not very much, just a little bit down in the after hours. So again, this 400 level in SPY, getting above and staying above is really, really important. We got the Arun indicator breakout here, so that's good that we kept this above 100, and you can see the whole moving average too. We're looking good there. We're at the highest level we've been above the 200-day haul all year long. So this is the highest point. The previous highest point that we had was again on that March 29th, and that ended up being the peak there. So this is now the new highest point that we have on above the 200-day haul. It's a good bullish candle. We're well above those parabolic SARs. The hull is still green, even if the 200-day is red. The parabolic star is about to get above the 200-day hull on the downside. We did do that briefly over there because, again, that's a sign that things are changing to the upside, right? That things are looking pretty bullish there. So we had that briefly here, but by the time the dots got above the 200-day hull, we were already rolling over. So again, we really need to continue to see some good bullish candles here to get those parabolic stars to keep coming up and not peaking like we did in early April, end of March. We don't want to see that kind of peak because, again, we saw that was a lower intermediate high and it eventually led to a lower intermediate low point, and this would easily be a lower intermediate high at 38% retracement, very normal retracement in this case to the upside, and would be a you would expect a lower intermediate low, even if it's just a smaller one. You would expect a lower intermediate low to come out of it if we can't solidify this and really continue to move up to the upside. So what do you think? What are you thinking there? Do you feel like this bullish trend is established now? Are you looking at this as a kind of a sell to rip opportunity? Comment down below with what you're thinking, and especially with what charts or indicators are you looking at that we didn't discuss today that kind of dictates how you're looking at these things. Share those in the comment section down below. All right, now let's take a look at what's driving the price action today. Let's go to the asset class comparison chart, and let's just look at today alone. You can see the dollar is still a big gain over the last 3 months, and nothing else is actually up over the last 3 months of this last rolling 3-month period. If you go down to just today, you can kind of see how things were looking going into the meeting. So the Qs were already up thanks to Microsoft and Google. They were already up quite a bit. That lifted equities, U.S. equities in particular. IWM lagged behind, but they were still kind of pulled up along with international equities because of those positive results. Things were looking pretty good. The dollar was down, bonds were down, gold was down, and real estate was down. It was completely risk off. Post FOMC, the dollar just dropped like a rock. Yields rallied, so bonds dropped like a rock. Commodities stayed really strong. Equities stayed really strong, kind of built on their gains. And gold built on its gains, again, thanks to the dollar. Real estate rallying too. So let's take a look at the dollar, especially relative to, this is the chart for the VIX. You can see this is a period of time in the summer where the VIX gets more volatile. Going into the earnings season of in October, and so that leads to a higher seasonal time for volatility. August, September, and eventually into the beginning of November is where we get that second peak average for the year. So we'll see how that plays out as volatility is down. This is the lowest period of time for volatility at the end of July. It's not the lowest this year, but we have been down. We have fallen throughout June and July like we seasonally do, and now there's a question of whether we seasonally rise up to the upside. Let's take a look at the euro here. So euro relative to the dollar, and you can see we had a really good day after breaking down the prior day back below the 8-day moving average. We got back up above it, and we'll see if we end up kind of holding that. Again, this dollar's very strong, and in the past it's not been very good to have a strong US dollar. Like, again, every other time we've had big moves to the upside in the dollar, the Fed has come through with accommodative actions to help ease the strength of the dollar. And really the dollar wasn't even that strong. Like the dollar's a lot stronger now than it was when you had QE1, right? The dollar's a lot stronger now than when you had QE2. The dollar's a lot stronger now than when you had QE3. The dollar's a lot stronger now than when you had QE4, along with all the fiscal stimulus that pushed us up from a strong dollar move. And you can see, all the fiscal stimulus we had coming out of the strong dollar at the end of 2016. We had all the tax reforms and corporate regulations for a beginning period of time that was fueled by, that help offset the strong dollar there. As of right now, we don't have that. So we might be at a strong dollar level between 115, 101, 115 for quite a while. And again, that's generally has not been good from a U.S. economic standpoint. to have the dollar that strong, unless you have a explosive real estate sector, which is what kind of fueled the rally off that bear market low point in '03, right? You were fueled higher by the real estate financial sector, and then eventually commodities here going into the summer of '08. They all kind of rallied there off of the strong dollar. So it's a matter of, like, the problem is we've already had an explosive real estate market that's really coming in, kind of like what we saw over here, really coming in, peaking and rolling over. So we're not going to have that at the low levels like we had, and again in '03, '04, to kind of help provide some fuel for the economy to grow there. Those technology stocks couldn't, because the dollar was so strong. The dollar had been so strong at the end of that bear market. Let's take a look at bonds. So interestingly enough, and I tweeted this out, and I had this up here, so it's right here. So on June 14th, June 15th, so this day, the Fed raised rates 75 basis points. And so that was a jump from 50 to 75. And the Fed said, hey, like, we're going to do whatever it takes to defeat inflation. Usually, to defeat inflation, you got to raise the cost of money, which is these interest rates. And that's what they do. They raise 75 basis points. They raise 75 basis points again today. The problem is that from that day that they came out and said, we are going to bring down inflation no matter what it takes, the 10-year yield actually dropped 75 basis points. Remember, the Fed raised interest rates today by 75. The 10-year dropped 75 going into today. It's a 75 basis point drop while the Fed is supposedly trying to combat inflation. That's not necessarily the best thing. I mean, the bond market is basically saying, because again, as I showed you, from June 14th, we had a positive spread, a small spread, but a positive spread. Now we don't, right? Now the spread is completely gone. And you can see that the 10-year, we had a really strong spread going into that meeting. And that's kind of why he said that. In June, he had a lot of room to be able to say, you know what, we're going to do whatever it takes. Because the 10-year was so far above the 3-month, and it was kind of all year long kind of at those levels. 10-year was rising, 3-month was rising, things were looking good. But the 10-year peaked on June 14th and has been dropping instead. And now look at the yield spread between the 10-year and the 3-month. It has dropped like a rock, to the point where the Fed is almost to the point of saying, you're done. I mean, of course, the futures market is pricing in, you're still going to get about a 70% chance of 100 more basis points over the course of the next 3 meetings. You got a 100% chance at 50 basis points, 100% chance right now at 50 basis points to get you to 300. Now keep in mind, the 10-year is not at 300, right? In fact, right now the 10-year is at 275. The overnight's at 250. Like, you might have a situation here, by the time we get to September 21st, the 10-year might actually be below 250. We might have a rate hike for one of the first times that we've seen where the Fed funds was already above the 10-year when they hiked, right? The 3-month might already be above like 250. Like, it might already be above the 10-year by the time we hike. Like, so we're inverted, right? And that's not common for there to be that inversion of the 10-year 3-month and the Fed still raising interest rates, especially raising them by 50 basis points. So it's interesting to see how the bond market has basically told the Fed, you're done. Maybe another 25 basis points, maybe, but you're done. And the futures market's like, well, you got 50 here, you got 25 here, you got a 100% of 25, and then, like I said, you have a 70% of another 25 in December. So 170% for 100 basis points going into. And there's a 100% chance of 75 more basis points, which would be 300 to 325. And again, that's well above where the 10-year, the 2-year, the 3-month. That's well above where all those are. And you can see it's not common to get the overnight rate up above that level. And the Fed can't raise interest rates. If the Fed can't raise, this is the 3-month, which is very attuned. The red line is the 3-month. It's very attuned to what the Fed is doing. You can see the last cycle, it never did get above the 10-year. It came pretty darn close, but never really did get above the 10-year. It basically, the 10-year fell down to it, and they had to start cutting rates. Once the 10-year dropped below the 3-month, they had to start cutting rates over there. Back here in this 06-07 period, you can see how they raised rates to get up to the 10-year, and once the 10-year dropped below the 3-month in June of 06, they stopped raising rates. They stopped at that point in June of 06. We're not quite there yet, right? See if you go to a daily chart on this yield spread, give it a second to come up. So we're not quite there because you can see the 3-month actually dropped a little, and you can see where the 10-year, that's actually going into today. But that's a 26 basis point gap. Look how big the gap was between the black and the red lines, and now look at where that gap is. And the 10-year has been dropping to the 3-month like we've seen before, and you can see we're inverted by quite a large amount. We're inverted on the 10 versus the 2. So there's not a lot of runway anymore from a yield spread perspective, even if there's still a tremendous amount of runway when you look at the financial stress. Like the financial markets are saying you can raise rates all you want, which will be interesting to see who the Fed listens to. Right, the stress in the markets, which is giving them lots of runway to raise rates, or the bond markets, which are saying you've got no more room left to go. Like, you have raised rates enough that it's really hampered the ability of the economy to continue to grow. And we saw that last quarter, and we're going to see that in the next quarter. We're probably going to have. Now, these aren't, remember, you have to keep in mind, we had some really strong levels of economic growth over the last 6 quarters, way more than offsetting those 2 quarters in Q1 and Q2 of 2020, way more than offsetting that. So you can see we pretty much offset those 2 quarters. We pretty much offset those in the first 3 quarters, and then some the next 3 quarters. So to drop 1.6, to drop another 1.6 isn't necessarily recession, but as you can see from a national activity index survey, we usually, we're negative now. Now, in the past, the Fed hasn't stopped rate. You usually, by the time the market starts its correction, this is already down to 0.35. We're already in 6 months into correction. We may have already ended the correction before this even got to 0.35. That started recessions back in the past. So it's kind of get the idea that you've got a little. We're seeing some signs of economic decline, but not recession per se. But the bond market says you're pretty much like, if you keep going, you will send us into recession because these long-term rates are falling now. They're not growing, and there's no way. See, in 04 and 06, they were able to keep up for a while, right? If you look at, let's go out to 20 years. If you look at that 04, 06 period, give it a second to load in. So way back over here. If you look at this 04, 06 period, you can see by the time you got about halfway through, initially when you started to raise rates, the 10-year rate was coming down. But eventually it started to rise and was able to kind of keep pace. You can see the black line was able to kind of keep pace with the 3-month until about the beginning of 06. And then at the beginning of 06, they kind of caught up to each other. The 3-month, you can see to the right of my cursor, caught up to the 10-year. And then the 10-year actually rallied for a good chunk of 06 and right up until they ended raising rates. And then it stopped. The 10-year fell below the 3-month, and we were done, right? And we were inverted. The 10-year was below the 3-month for a good chunk of time. So there's the 10-year. You can see it on the chart throughout all of 06, beginning of 07. There's the 3-month, right? This 3-month here was up above it. Here's the 6-month was well above the 10-year for most of that 06, 07. So we were inverted for a good chunk of time there. And remember, the stock market didn't really actually peak until 07, and that's when we started to correct. So we're just kind of in potentially this stage right now when you look at it from a yield spread. But the Fed could raise rates because the 10-year was able to jump higher. If the 10-year gets to these levels, is unable to jump higher in that September meeting, if we end up raising rates, the Fed funds up above the 10-year at the September meeting, they're done. They're done. They might only do 25 at the September meeting, and then they're done. If that, right? If the 10-year can't rally with that rate hike again, to see, like it pretty much didn't do today. And again, you can see like it rallied here. If I were to go out to the 5-year or 5-day chart here on the 10-year, like it rallied here at the end, but it didn't rally up above where we were already at going into today. So if the 10-year can't rally on these rate hikes, then the Fed's done, right? The Fed will be done, and the market's got a lot bigger concerns with strong inflation that the Fed now can't do anything about, and a yield curve inversion that's not and a strong dollar and negative GDP. Right? Negative GDP, slowing economic growth, as you can see here, as well as, here in this National Activity Index, smoothed out over the last 3 months. All right, now let's take a look at our trade idea of the day, and let's take a look at PayPal. PayPal, as you can see, has been really bearish all year long and is up to $86, well off of its highs, but also well off of its 52-week lows. Intermediate line getting into bullish territory. We're at 15% above the 30-day moving average, which is now turned up. So we have dark green shading in the green line, which has been pretty rare. We got it over here. We had a brief bullish move there. We had a brief bullish move here. And this one looks like there's a good potential. Again, with the higher, this is the highest that we've been above the 30-day moving average all year. There's a good potential we can get up to a higher intermediate high point, and that's a good sign for PayPal. You can also see too, when you look at its long-term chart here, we got a green arrow on the, we're way 40% below the 10-week and below the 40-week, but we have a rising PPO, we have a good bullish candles here, positive differential, and a green arrow. That's a good sign for PayPal from that perspective. And you can see, again, like the market itself, we got a rising MACD, 3 green arrows, we got a rising MACD there, and finally today a good break in volume, well above more than 1.5 times the average volume. This is what that looks like here on this chart. Good breakout move up above, multiple highs, and then we just ran away. And this is what it looks like on the daily chart here. Over 12% rally. We had a 11.5% rally over here. But we're coming off of a pretty significant decline, nearly 5% or over 5.5%. We way more than recovered that with a big gap to the upside, which we just haven't had. See, we didn't have that big gap over here. So tremendous gap to the upside, following through with a good move up there. When you look at it on the 3 green arrow chart, you can see that we are well above the 50-day. The 8 and 17-day moving averages are positive and above the 50-day as well now. You can see the volume down there, and you can see a big gap between the 50 and the 200 potentially to fill. From a weekly chart, you can see a good bullish candle there and a significantly rising MACD that gives us the opportunity to get above this point of control and above that 17-week moving average. Looking at some of these oscillators, you can see the breakout patterns here, breaking out on the DMI above 30, below 20. So we got light green shading now because the ADX is up above 20 and rising again, so a good chance we can get the dark green shading. If you look at the RSI and the CCI, we are above 60. We'll see. Remember, if we can get above 70, that can really hold this breakout that we're getting here. If you look at on this squeeze pattern, you can see how we're pretty much getting through the Bollinger Band and through the Keltner channel. So good breakout, the green dots and positive momentum. Good breakout patterns there. For Ichimoku cloud, we are now into the cloud and potentially starting a bullish trend that we haven't had all year long. Right? It's been bearish, strong bearish trend for most of the year, but a bearish trend all year long. And then there's your value area, again, above the point of control. Very wide value area because we just don't have, once you start to rally, there's not a lot of move. Now, granted, volatility is going to limit its upside, by September expiration to right around the 102. So what I decided to do here is do a bullish trade, do a directional bullish trade, but not one that needs a significant upside move. So if we can get above 90, so we'll buy at the money, so buy with the highest extrinsic value out to September, sell the first strike price away, and you can see there for about $1.20, so about $500 of risk to try to get a $500 reward. Remember, typically in relatively high probability trades like this, we're risking $1,000 to make 300. So here I'm risking half of that 1,000 to get more than 300, to get about a 1-to-1 reward to risk ratio. Again, a relatively higher probability directional trade. Remember, directional trades in and of themselves are low probability in nature. So this would be on the higher end of probabilities for what is typically a lower probability type trade. But now I don't need a big setup. I just need to get above 90, which is right where my cursor is. I need to get up to new highs and stay there, which it looks like we're getting the strong enough momentum that gives us a chance to do that. Alright, well that wraps us up for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, like us on Twitter and Facebook as well. Subscribe to our website for free at marketscholars.com. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.